Tonight, my topic is going to be regarding the Registered Disability Savings Plans, or RDSPs. RDSPs have been around since 2008, and a lot of people still don't understand what they do, how they work, and the benefits that are provided by this government generated plan. Our agenda for this evening is we're going to talk about what is an RDSP. We're going to talk about different terms, what a holder is, who a beneficiary is, how you can actually contribute into and grow the RDSP, and what kind of maximums are in place from both a federal and a federal government standpoint regarding income, grants that you can receive, bonds, etc. We're going to talk a little bit about how you take money out of your RDSP and the types of payments, the taxation issues that might be created. The AHA is the assistance holdback amount, and that's the catch. RDSPs are an amazing tool, but there's always a catch when there's something so good. And I'm going to explain that for you because it's not as bad as it sounds. And then what happens when you close an RDSP? An interesting statistic is that 28% of those who qualify for an RDSP have, only 28% have opened an RDSP for those who have qualified since the program originally opened in 2008. It's an amazingly underutilized tool that can really generate some good wealth. Really, it's because Canadians don't know and understand how it works. When RDSPs came out, tax-free savings came out in a year. Everybody knows what a tax-free savings account is because the banks advertise them. They don't talk about RDSPs because you have the eligibility requirement in order to obtain one. Eligibility is that you have to be eligible for the disability tax credit. We talked about this the last time I was on 2 weeks ago. You have to apply for the disability tax credit using the T2201 disability tax credit form. Any Canadian resident is eligible to have the disability tax credit and then be eligible for an RDSP, provided they're under the age of 59.
I don't tell them to shut the TV off.
So if you are a Canadian resident under the age of 60 and have a valid social insurance number, you can be eligible for and you're eligible for the disability tax credit. You can have an RDSP. How to open an RDSP? Basically, you have to understand a couple of terms. One term is holder. A holder is someone who opens and manages the RDSP on behalf of the beneficiary. The person has to be authorized to act on behalf of that individual, whether it be a parent, a family member, a close friend, or even a legal representative like a formal guardian or a trustee, a representative. They have to be able to demonstrate that they have decision-making ability over the plan for that individual in order to manage and direct how the investments are done within that platform. And you can't have more than one RDSP holder on an account. As an example, one family that I work with in the Richmond Hill area, we have 5 different holders on the plan, just in order to make sure that each generation is represented in order to protect the individual, the beneficiary, in the event that something was to happen to the other family members. The RDSP beneficiary is the person who is having the RDSP developed on their behalf. The beneficiary can also be a holder, and that's quite common. The RDSP is a very tightly regulated program, and you can only ever have one RDSP at a time. You can have more than one tax-free savings accounts. You can have way more than one RRSPs. You're just limited on the contribution amounts that you can put in. With an RDSP, if you have more than one RDSP, the government shuts down all grant and bond applications until you fix and eliminate one of those 2 programs. That's how tightly regulated this is. And there's only one beneficiary allowed on an RDSP program. How to open an RDSP is a very step-by-step process. It actually involves substantial amount of paperwork, particularly if you don't understand what is required for that one individual.
Somebody's talking now.
Basically, what you do is you make sure that you're eligible for disability tax credit. You obtain and complete the RDSP from whoever the provider is going to be for the RDSP. And then you complete the grant and bond application form that the government provides. That's either Annex A, the Canada Disability Savings Grant and Disability Savings Bond form, and or the primary caregiver application disability savings grant and bond form.
Get this out.
Basically sign the documents and send them off to your provider. All of the major banks provide RDSPs. Global MaxFin in Richmond Hill offers the RDSP program, and Investors Group, they offer an RDSP program. However, they use Mackenzie, who on the advisor side, the side that I'm on, that's who we all use as well, Mackenzie Investments. Contributions can go in by anyone. Basically, your contribution program, the people who, anybody that the holder will authorize to contribute money into an RDSP for the beneficiary. So for instance, if you have a family and the family wants to put as much money into the RDSP as possible, Uncle Bob can put money into the RDSP for Glenn, provide Glenn's parents say it's okay for Uncle Bob to do so. They just complete a form. It's very simple and it's very easy to do. The reason to be cautious is because you receive federal grants and bonds for your contributions. Transfers within the RRSP, retirement income funds or registered pension plans, can also put money into an RDSP for clients. This is really important when it comes to estate planning, that if a family who's taking care of a child, an adult child who has an RDSP, and they wanted to leave money without losing any of their ODSP benefits, they could direct the RRSPs or RIFs right into the RDSP, and it sidesteps a lot of the compliance issues when it comes to the ODSP benefit. RESP, so if a child has an RESP and they're not able to utilize that RESP, they can transfer the funds into the Registered Disability Savings Plan, again, reducing any tax burden from that. Grant and bonds are basically the important parts of contributing money into an RDSP. You're eligible to receive matching grants from the government or Canada Disability Savings Bonds into the RDSP up until December 31st of the year that you turn 49. For every dollar you put in, you're entitled to receive a matching grant. So if your family net income is below 98,000, and these are 2021 ratios, if your family income is $98,040, for the first $500 you put into your account, the government matches 300%. They give you a $1,500 grant into the RDSP. If you put another $1,000 in for the next amount, that's 200% matching grants. So $1,500 generates a $3,500 matching grant. It's an amazing program. It works incredibly well, and you can recapture grants from previous years, provided you go through a schedule, which I'll show you how to do that. If your family net income is above 98,000, for the first $1,000 you put in, the government gives you $1,000 per year of eligibility. So it's only 100% matching grant. Still an amazing return on your investment. Canada Disability Savings Bonds are basically free money. So the grants you have to contribute to receive The bonds, you merely have to be eligible in order to receive. So if your net income, if your family net income is below $32,000, so family net income is if you are a single person, it's based on your income solely. If you're above the age of 19, if you are married, it's you and your spouse. If your income is up to or equal to $32,000, you're entitled to receive $1,000 per year into your RDSP. The government just puts it there. If your income is between $32,028 and $49,020, you'll receive a portion of that $1,000 based on a curve prorated in order to determine what you would receive. If your income is over $49,000, you're not entitled to the bond at all, but you could be entitled to it for either previous years or next years. Whoops. The understanding how grants and bonds work. So if you get someone who's entitled to receive grants, they were approved for the disability tax credit to, let's say 2010 is when they got approved retroactively. If in 2020 they opened the RDSP and they put $3,500 into the RDSP that you can see here in red, that $3,500 would be entitled to receive a 300% matching grant from the federal government for the entire 7 years prior. That's $10,500. The government limits the amount that you can receive in any 1 year to $10,500. Year two, if you wanted to still recapture some of those matching grants, in year two, you could put in $4,750. You can see where the two purple 300% matching grants are highlighted at $1,500. And then you get into your 200% matching grants, showing where it would be caught up in the previous years. Year three, $5,000 generates another $10,500 in matching grant. So you can see the accumulating totals in the balance column. In year four, where you've contributed $5,000 overall as a family, you've contributed just a little bit over $18,000, but the RDSP balance is $86,750, guaranteed based on the grant entitlements that you're able to have. This does not calculate any interest at all. This is just showing the guarantees that you're entitled to receive from the government. This is truly an amazing government program. Taking money out of your RDSP is what we really want to know. You have to be careful because something called the assistance holdback amount applies for every grant or every dollar that you try to take out of your RDSP prior to age 60 or having the grants and bonds for a period of at least 10 years. RDSPs are intended for a long-term savings plan, and the assistance holdback amount ensures the government funds aren't withdrawn and recontributed to keep on getting additional matching grants. You're penalized for taking those out if you try to take them out, and they take back all of those grant entitlements. The rule is that for every dollar you take out of your money, the government takes away $3 of theirs. Impact on social assistance benefits. RDSPs are exempt under the old age security calculations, guaranteed income supplement calculation, Canada pension calculation, GST, or social assistance plans like ODSP or Ontario Works. They're fully exempt and they don't take away any of your eligibility or qualifying for any of the social programs that are available to you. That is based in Ontario, so if you know somebody who's outside of Ontario, it might be slightly different, particularly in Alberta or New Brunswick. When you take money out of your registered disability savings plan, basically there's two different types that you would want to look at. The lifetime disability assistance payment is when they do a calculation, which is an incredibly fair calculation to determine what you can receive based on the contributions you put, the grants that you've received, the bonds that you've received, and the interest growth that you've had on your RDSP. The LDAP, or the Lifetime Disability Assistance Payment, is a recurring annual payment, and it works out pretty close to about 4.5% of your net amount. So if you had, let's say, $200,000 in your RDSP, you would receive just a little bit over $1,000 a month coming to you on a regular basis for the rest of your life at age 60. That $1,000 a month is exempt from old age security, Canada Pension, Guaranteed Income Supplement, ODSP, Ontario Works, any of the social programs. Payments are limited to a maximum tied to the fair market value of the beneficiary's life expectancy. And the maximum doesn't apply where a physician certifies that the beneficiary has less than 5 years to live. If you've been diagnosed with less than 5 years to live, then you can start to withdraw more money out of the RDSP without penalty. A disability assistance payment is an extra payment. So the lifetime gives you that income for life. Disability assistance payment can top up and take out extra. You can take out up to a maximum of 10% of your RDSP, provided that the plan is not exceeding the qualifying criteria if it's a primarily government assistance plan. That means that more grants and more bonds have grown the wealth within the RDSP than the accumulated money that the family has put into it. Taxation, government likes to get us in all the avenues, but they do tax the RDSP, but because you're eligible for the disability tax credit, you're going to get that tax money back at the end of the year anyway. Okay. Three important things to remember when it comes to taking money out of an RDSP. The 10-year rule is any withdrawal that is made, all federal grants and bonds that were paid into the RDSP within the previous 10 years could be subject to a 300% clawback if you try to take money out. Tax deferred growth, the money that grows within the RDSP is tax deferred, and you don't get taxed on it until the beneficiary starts to withdraw. But like I said, that beneficiary is RDSP eligible. They would get to recapture that tax money at the end of the year. And grants and bonds, they are optional, but they really help grow the RDSP based on the 300 and the 200% matching grants. And like I said, worst case scenario, you could be eligible for $1,000 match per year. We just talked about that. So what happens if they came up with a cure and they eliminated the key reasons why you're eligible for the disability tax credit? You have two options. You could collect the RDSP, but if you did that, any grants that you've received and bonds that you've received would be subject to clawback from the federal government based on the previous 10 years. You could also put the RDSP on hold in case you became re-eligible. In that circumstance, you basically put it on hold. You're not allowed to contribute it and contribute to it or to make withdrawals. But it continues to grow and gain interest for you. If you do become RDSP eligible again, you can continue with the DTC eligibility once you have that reinstated. If the beneficiary of the RDSP was to pass away before being able to access the RDSP, any grants and bonds that you received less than 10 years previously would go back to the federal government. Any grants and bonds that you've had for greater than 10 years stay in the RDSP, and the entire RDSP goes back to the estate of the individual, generally to one of the, addressed to one of the family members to which the individual has been working with the advisor. All of the mutual funds are basically, we have to provide this disclaimer anytime we're talking about mutual funds. that they're all subject to commissions, trailing commissions, and management fees, and all structures are being reevaluated, and the limitations are being changed as we speak right now, completely within the financial world. It's always good to talk with someone who really knows what they're talking about when it comes to registered disabilities, savings plans, and other investments.